Well, welcome everyone. We are now at the halfway point tonight. After tonight's class, we will be covering Chapter 6, which is on reinsurance. I want to say risk financing. Obviously, that's what we're doing, but reinsurance tonight. And actually, of all the chapters we've done so far, this is the one that's actually generated the most questions. And I liken it a little bit to, no one ever really sees the reinsurance people. They're kind of like actuaries. We always hear about them, but no one ever really sees one, or like leprechauns type thing. So they only appear during certain, circumstances where you're actually going to hear. It's really when a bad event occurs is when you're going to really hear about reinsurance and what's happened there. But they've been in existence for quite some time, and I'll try to give some background as well that's not necessarily in the book, but will help maybe provide some additional context of kind of what we're doing here. So on the objectives, one of the things, there's only about 5 or 6 objectives there. And there's a lot of concern when you read through this about, okay, the pro rata share and all those different types of reinsurance and what they are. And I guess what I want to do is kind of calm your fears, at least for the test. I mean, you could actually take a semester course just on reinsurance and the different types of reinsurance and all those type of things. And actually there's books just on these different types of insurance. So the idea here for the exam is to have that 50,000 foot level of understanding how reinsurance works, what the different forms of it are, and how they would be used in different ways. There's not an expectation where you're going to have to say, okay, how much is someone going to get charged for it, those type of things. But you want to understand how, okay, if you have this, what's 5x of 5, those type of things to have a basic understanding. And so if you're a risk manager and you're in a situation to where, with a broker, someone says, we have this reinsurance or this is what's going to be happening, you'll have at least an understanding of what's covered and what's not to be able to ask intelligent questions. And that's really what this chapter is looking at. So for our objectives, when we look at that, describe reinsurance and its principal functions. So really, what are the key concepts there? The 3 sources of reinsurance, of how that, so how does reinsurance actually occur? Describe treaty reinsurance and facultative insurance, and so we'll talk about those 2. And then once we get into that, there's the other types, which is the types of pro rata insurance and excess of loss reinsurance and their uses. And so why would you use one over another might be some of the type of questions there. On the pro rata reinsurance, I wouldn't expect a whole lot of questions, specifically on the quota share and what's the percentage and those type of things. But just to understand in general, what pro rata insurance is compared to excess of loss insurance, and how they're just different used. And then finally, explain the reinsurance concerns from the risk management professionals. What would be the questions you want to ask for that? And we've actually had some really good questions tonight that people have emailed in that, for example, well, who regulates the reinsurers? How do we know that they have enough money to pay for claims? I mean, on those type of things. And so we'll talk a little bit about some of that as we go through. So as we just go from a general concept, reinsurance, what is it? Well, it's insurance for insurance, companies. That's really what it is in the grand scheme of things. And so for many, it's hard to kind of get your arms around it because we're used to just dealing with, okay, we buy our homeowners insurance, and we don't think of, okay, if I'm with State Farm or Allstate or whatever, they're buying reinsurance if something was to happen. And we don't think about, like, okay, let's say the wildfires. We've had a whole bunch of wildfires in Northern California. We have a whole bunch of homes that burned down. Well, if Allstate doesn't have enough money, they have the reinsurance that will cover those, but the check still comes from Allstate. All what's happening is the reinsurer is reimbursing them for those liability losses. And so that's why most people don't hear about the reinsurers, is because it's really just, they're providing the funding mechanism from the liabilities that they incur. So to get from a definition standpoint, it's a transfer of insurance risk from one insurer to another through a contractual agreement in which the reinsurer, in return for the reinsurance agreement, indemnifies the primary insurer for some or all of certain loss exposures covered by the insurer's policies. Now, as we go through, it says some or all. It really depends from the reinsurer standpoint, are they going to take on all the different types of policies? Because you might remember that Allstate might write a policy for homeowners, and then there's umbrella coverage, and then there's auto, and so depending on the types of loss, they can decide they're only going to cover certain lines of coverage when they do that. And again, when we talk about indemnify, what that means is that indemnification means they're just reimbursing money. That's what really the all indemnification is, that they're going to indemnify the other organization so they're not losing any money that they normally would through there based upon what the primary is going to retain. So as we talk about tonight, we're going to be really talking about primary and then the reinsurers and how those two play. And so we kind of have to move out of our own thing of that. As risk managers, we might be retaining risk, but we have to think, okay, it's kind of that, take a step back and you're kind of looking over these things. You have the primary and the reinsurer, and look at how those things interact and take yourself out of the picture. And that might make it easier to kind of to visualize how this all works. Okay? And then finally, when we talk about insurance risk, what is that? It's certainly about the adequacy of insurance premiums to pay losses. And so when we talk about financial risk, reputational risk, all those things, well, there's insurance risk. That if I'm an insurance company and I write coverage for certain policies, there may be a possibility that while I might have a certain amount of money to pay for losses normally based upon what the actuary says, we can expect to have these trends. And this kind of goes to another question that was sent as well. Why would you write policies if you don't have the money or if you think that you need reinsurance? Well, actually, the laws at this point regulate that as an insurance company, you can only write 10% of your net worth. So if you collect $100 million, you can only write $10 million with insurance policies, meaning that you have the assets to do that. Part of the reason for that is that if you have extreme loss, if you had a huge loss, obviously you'll have the money to be able to pay for that. That's to help provide that. But if you think about we looked at the other chapters and we saw losses, and all of a sudden you see a major loss where it was way out of whack. Normally you say, let's say workers' comp, on average we have we pay $500,000 is the average claims we pay each year. Well, maybe one year we pay $5 million because we had a really bad situation. Well, how are you going to pay for that catastrophic loss for Hurricane Sandy? I mean, the reality is that reinsurance is really for those catastrophes, those type of events that we wouldn't normally expect. Because through regression analysis, the actuaries are going to say, this is what we expect. But the insurance company is really just buying that reinsurance for that one odd situation that, oh my gosh, so the insurance people can sleep at night. Just like we buy insurance so we can sleep at night, they're buying insurance so they can sleep at night, and that's maybe the way to kind of think about that. The other term that you're going to hear is retrocession, which is an reinsurance agreement whereby one reinsurer transfers all or part of the reinsurance risk as assumed or will assume to another reinsurer. So it's similar to reinsurance, except for the parties involved are not the primary insurer. So this is actually fairly normal. What I would say is that if I'm a reinsurer and I say I'm going to reinsure $20 million worth of the risk, what I may do is say, you know something, I'm going to sell that 10 to 20 million later to another reinsurer. So I'm going to transfer, I'm going to retrocession it basically. They're going to take on that piece. Or maybe another form of retrocession is that we all go in it together at that layer and say we're all going to go in and pay a third. They're going to help pay. They look at the underwriting criteria and they say this looks like it's a good risk that they'll take it on. And then sometimes what happens, there might be trading of risks. So if I'm a reinsurer and I'm writing a whole bunch of risk in California where there's earthquakes, and someone has a lot of risk where taking on policies in Florida and the East Coast where there's hurricane risk, they might, and they're thinking they might be taking on too much of that, they might trade some of the policies and say, okay, we'll trade you some earthquake risk for some hurricane risk so that they spread out their risk portfolio a little bit. So that might be another reason that they might do it, but they're going to make sure the underwriting criteria. So, but the whole idea of retrocession is that the reinsurers also sell to other reinsurers, the risk of the other layers that may be taken on. So we look at the basic function. So the purpose of why do we have reinsurance, and this is something if, from a question standpoint you'd most likely see on the exam. So what does it function? The first and primary is increases large line capacity. Is that at a certain point, because of the way the regulations work in the U.S., I can only write so much coverage based upon what the money that I collect. And so what it allows me to do, it frees up some capital by having someone take on the extra layers, and then I can basically take on other types of risks. So it allows me to expand my portfolio because I'm not going to, instead of writing up to $10 million worth of risk, I can write maybe up to $1 million and sell that risk to the reinsurer to take on. So that gives me some more flexibility for large line capacity. As we mentioned, provide catastrophe protection, Hurricane Sandy, all those type of things, floods, climate change now, so catastrophes, the Philippines, Typhoon Haiyan would certainly fall into that category of providing some catastrophe protection. And the other thing I guess you'd have to keep in mind when you think of writing policies, obviously there's typhoons in the Philippines, you're having to expect that, and hurricanes. The policies in the U.S. or developed countries are going to be more expensive than possibly the Philippines because the infrastructure, what's there, what does it cost to rebuild in one area compared to another? And then also, I would say in a lot of developing countries, most likely they don't even have primary insurance. There may not be that except for those large companies that are operating there will probably have the insurance to be able to rebuild, but most of the other folks probably don't. The idea of homeowners insurance like we have is probably a foreign concept to most other developing countries, based on what they have. And also, the other reason why you wouldn't, as an insurer, you probably wouldn't want to write it is that building standards. In the U.S., we have strict building standards. We know that things are being built to. In other countries, you have to know what those building standards of whether you're going to insure those type of events. So all that goes into the underwriting criteria of where the primary insurers are writing policies of whether they're going to take them on. Stabilizing loss experience. So I kind of mentioned this, kind of goes to the catastrophe protection, is that the idea is that if you know your worst case scenario as an insurance company, you're only going to take $1 million hit, that gives you a lot more flexibility to know that you're not going to, the fluctuations you can have within a band, that your fluctuations are only going to occur between 0 and 1 million rather than 0 and 5 million of what you're going to have to pay out. And of course, when we talk, primary and reinsurance, I mean, the reality is $1 million policy, when we talk reinsurance, we're talking nearly in the $20, $25, $50 million range is really where the attachment points are. The examples they give in the book are $500,000. I don't think you'll ever see a primary doing that, and then maybe really small, but I just don't see that really happening. Providing surplus relief. And we're going to get into some of these a little more detail on what surplus relief is, but the idea that this has to go to the net capital requirements of how much the regulations might require them to keep on hand, and by doing this it provides surplus relief, and I'll help explain that here in a moment. It also facilitates withdrawal from a market segment. So this is what I was getting to, that if I decide that I'm writing policies, and there's several companies that decide not to write policies in California, homeowners policies. They just stopped doing it. They either didn't renew policies anymore, and part of it was because they felt they're taking too much risk on. They had too many policyholders in there. And so what that allows is that they can withdraw from the market or allow those policies to stay in force, and they can move on, and essentially the reinsurer will take on those policies from an indemnification standpoint. They'll pay for that, and so then it releases the capital requirements, and so it allows someone to leave the market. And so it's kind of like a lost portfolio transfer in some ways, and we'll talk more about that as well. And then finally, the other function is underwriting guidance. If you think about it as a primary insurer, to have to deal with a hurricane, you probably don't deal with that often. But as a reinsurer, this is something, because they're worldwide when we talk about reinsurance, from a global perspective, they have a lot more experience to decide, understand how much these type of events cost, and so they're going to have a lot better underwriting criteria of what is a good risk if someone's going to be going into a certain area. And so they have a lot more experts that can help say, you may want to include this type of criteria or exclude this type of risk. For example, one of the things in the article that I sent out today as part of this, it talks about the top 10 risks in there. And one was climate change and their cyber risk. Well, they have people that are assigned really looking at what's going on, and they're looking at all the trends of climate change and how do we address some of those. So that just becomes part of it also. So kind of going in more detail about large line capacity, which is the insurer's ability to provide larger amounts of insurance for property losses or higher limits of liability for loss exposures than otherwise is willing to provide. So the idea that now, because of reinsurance, maybe I would normally offer only $1 million in coverage, and I have someone that says, I need $5 million of general liability coverage. Can you do that? And if you don't have the reinsurance capability, you wouldn't be able to. So this kind of also goes to the question, why would you write something if you don't have, if you're not able to do it? Is because if you don't, someone else will. And that's part of the competition aspect, is that that it's going to provide more capacity by having that reinsurance market, and then so the reinsurers are basically competing with each other on certain things, and other types of coverages are working together. When we talk about the line, what is a line? When we talk about line capacity, it's a maximum amount of insurance or limit of liability that insurer will accept on a single loss exposure. And so some of the things it talks about that might be influenced that would be insurance regulations that have limits. So if for medical malpractice, okay, some states have limits on payouts on medical malpractice claims, some don't. They have punitive versus not. You might have if it's a workers' comp or general. I mean, it depends on the state. They may have caps on certain things, or they'll specify exactly what does have to be paid, on those. Size of potential losses that the insurer can retain. And then also we talk about line characteristics of loss exposure, and then the amount, types, and cost of available reinsurance. So when we talk about a line, we're talking about a line of coverage. So workers' comp, we have a fairly good idea. There are state statutes of what's allowed. In most states, you can't sue the employer for it, unless there's negligent activity. And so there's formulas that guide that. So that's a fairly, stable line. Whereas if you go to property coverage, well, depending on where you're at, it could be stable or not, because you have wildfire risk in Colorado and the Midwest. You have earthquakes in California, tornadoes in the Midwest, typhoons, and I mean, you can kind of think, if you look, from an insurance standpoint, you can say they can identify for property, here's the types of risks. Or they might have high crime, arson rates, other types of things. So those can drive, and all that type of information is really available to insurance companies when they look at these things. We talked about catastrophe protection. I think, hurricanes, I think we all recognize this, but provides financial protection from a single large loss event. And so that's where the catastrophe type of insurance would come. It can stabilize the loss experience, basically, and how it can stabilize would be limits liability for one exposure, or limits liability caused by a common event, or limits liability for loss exposures that aggregate over a period of time. So there's, asbestosis, there's the funds for those type of claims. So someone, or black lung disease, there's actually there's a federal program for those that are coal miners that basically over a period of time, if they can recognize it, they can receive funding from that. So there might be insurance programs specifically for those. And so if it aggregates over a period of time, once it caps essentially from the primary, and then it would transfer to the reinsurer. So that's how you can stabilize and know what your losses are going to be over that time period. So this is an example when we talk about stabilization of what this might look like here. That one down. So for this one, down below it says the total actual losses in this case are about 219.5 million, which is an average loss of about 21.9 million each time period. So if a reinsurance agreement were in place to cap losses to 20 million, the primary insurer's loss experience would be limited to the amount shown in the stabilized loss level column. So the idea is in year one we had 15 million, in year two we had 35 million, but the reinsurance picked up to 15, so we cap at 20. So basically the idea is instead of paying that $219,000, we only paid the $162 million in this case. And then the reinsurer picked up those bad years in which we had a catastrophic loss. But this allows us, again, from a stabilization standpoint, if you're to put it, I think, I don't know if the next one, if I put it on the graph there, this basically is the graphical thing that's in the book of the hypothetical losses, that you can see that now, from an average, the 21 million was the average that they kind of put in there, is that we're falling below the average by having that 20 million annual loss cap on there, and it really helps stabilize. Otherwise, you can see these peaks and valleys. And if anything, what kills insurance companies, or even if you're your own, okay, we'll go back to I'm an employer and I'm buying insurance. If you have these peaks and valleys every year from a planning, how can you decide one year you're going to make money, one year you're going to lose a whole bunch of money, and because of this. So the idea of having that stabilized, this is why insurance is important, because it really does help stabilize on many fronts. So the policyholder surplus, so we talk about provide surplus relief. This is what we're talking about. It's insurer's net worth as reported on financial statements provided by the state regulators. So when we talk provide surplus relief, policyholder surplus is the same thing as net worth. Okay, just I mentioned that, and I think in the book as well. And it represents the resources the primary insurer can draw on to pay unexpected losses. Now, you might want to say, isn't everything unexpected? Well, not from an insurance standpoint. The expected loss is you plan for it. Kind of goes back to this chart. Most of these in the bottom are expected losses. The ones on the top are the unexpected. Those are the things that were the rare events that we didn't expect. So the idea is that the policyholder surplus or net worth is that you're going to have the money for those expected losses that the actuary helps you project. But for those unexpected, that's really where the surplus or the net worth helps pay for those. And then typically the surplus won't exceed 3 to 1.
What's that relative to?
The surplus as far as the policy payments, as far as what they're writing, okay, on there. Now, the other part of it is that when you look at and talks about in the book and other places where I've looked, is that the regulations, you can't write more than 10% of your policy holdings. So there's a cushion in there, but you want to make sure that you have a sufficient surplus to basically pay for claims, and that's also the profit. That's all those other things that go into that aspect. The capacity ratio is the ratio of net written premiums to policyholder surplus. Okay, so if we think about it, written premiums is, so if I'm for $1 million policy, I might charge, let's say $500,000. Okay, so for that, I'm not going to charge you full $1 million for that, but so based upon all those policies, if I write 10 of those policies, that's $5 million, and I'm providing $1 million worth of coverage for each one of those. So the idea is that one of them has a hit, okay, I still have $4 million left, right? But if I have 2 or 3, then you kind of see how that goes down. So the idea is your capacity ratio is that in order for insurance to work, you need to have enough policyholders. And so to kind of bring this discussion to the Affordable Care Act, why they're so concerned with the young people signing up is you have to have enough, good risk essentially to help pay for the bad risk, which in this case would be probably the older population that is more expensive to pay for those types of claims. But you need to have at least enough people. Same thing with car insurance. The more people, the law of large numbers, the larger the spread. Your capacity ratio, you start looking at, that's where that comes into play, is how much are they going to have, what they think they're going to have to pay out versus what they're collecting in premium. That's the capacity ratio. And so it indicates a growing company has a much harder time to maintaining that ratio. So expenses to get new business is lump sum, but revenue from new policy may be monthly. So if you think about it, when you pay your car insurance, everything else, yeah, you get, let's say $1,000 a year. Well, you're going to pay $100 a month. So that money is not right there, even though it's showing that you're going to be collecting that money in the future. You don't have it yet. And so where this comes into play is that by having reinsurance, it allows a company that backstop, essentially, for them to continue to grow at a time. And so if you want to think about if you're self-insured and you want to start retaining risk, well, first you're going to maybe just do $1,000 retention. and eventually move to 5,000. And so where the university's at, we're 5 million, now we're talking about going 10 million. So the idea is over a period of time, you're growing, you can take on, retain more risk, and that's what the primary insurer can basically do, is retain more risk over time based upon what it's collecting in premium. So to facilitate withdrawal from a market, so when we talk about a market, a class of business, geographical area, type of insurance. So I mentioned a lot of we're pulling out of California. That was facilitating withdrawal out of California for homeowners insurance. So it was a particular class of business and a geographic area, and really a type of insurance as well as homeowners. So, so typically that's what you'll see is, reinsurance allows for that to happen. So what they would do is, as a primary insurer, they'd stop selling new insurance policies and let the old policies run off. Typically for homeowners, obviously it's a year at a time, so they would just say, okay, we're not going to renew. But while those policies are enforced, they need to still maintain. But there's certain things where maybe the policy, okay, so let's take, what's they call, a per occurrence, it's when the event happened. So it may be like workers' comp, that you may have a work comp policy, but the policy, someone reports an injury because it's an illness, maybe it's asbestosis or exposure where they say they got cancer. Well, it's maybe from, 3 years ago. Well, what's going to happen is that insurance policy goes to when the date of the occurrence occurred, and so whatever policies in force back then is where the policy would take effect. So that's where the reinsurance may kick in if they've withdrawn from the market or things like that. They can also cancel all policies and refund unearned premium. That I don't think really happens too often, where they say, okay, we're done. Or they can purchase portfolio reinsurance. And I put on here, it's similar to a loss portfolio transfer, which we'll talk about on the next slide. But the idea is that they basically sell, the risk, because there's no claims. With a loss portfolio transfer, they already know what the claims are. It's an old year. They say, okay, workers' comp, we know that all the claims are worth this amount of money, and then they have an idea. When they do a portfolio of reinsurance, no claims have occurred yet. They're really playing roulette and saying, okay, we think that the risk, your underwriting criteria is sound. That's what they're going to look at is, do you have good underwriting criteria, those type of things. And they're probably going to have to pay more than what they've written the policies for to get out of it, because at that point the reinsurer is really taking on the risk to do that. And what that allows is essentially is for them to get completely out of the market, while at the same time to make sure that those policyholders are in effect, because technically it's a contract. The contract until the policy expiration date, the contract's in effect, so they have to pay the claim. They just can't say that we're not going to, cancel it willy-nilly without doing that. So portfolio reinsurance, what is that? It's an agreement that reinsures the loss exposures of an entire type of insurance or class of business or geographic area. So again, they can say we're going to take all the policies in California, we'll cover those, or the homeowners, that type of thing. The primary will still manage and pay the claims, just like they normally would, but the reinsurer indemnifies. They'll pay back the primary for losses. So it's intended for future claims, not buying old claims. So the primary is still going to have to do the legwork, but what essentially is happening at least is that they know their losses. They're not going to take any more hits. They've capped their losses by having the reinsurer take that completely over. And novation is an agreement under which one insurer or reinsurer is substituted by another, and this would be a loss portfolio transfer. And so the difference here is that completely under the agreement that it's just like when you're, if you refinance your house and you maybe had the one refinance company, all of a sudden it says, oh no, we bought your mortgage. It's kind of the same idea. Someone else just bought your insurance policy under that reinsurer. So the reinsurer is substituted by another. So it could be another primary insurer that can do it, or it could be a reinsurer that would take it over. And so that's what novation is. And then the other part, the last quick piece on this one is provide underwriting guidance. And again, since they work with a wide variety of exposures, they have more experience in dealing with large loss events, they'll be able to help better with pricing policies and also looking at the underwriting criteria for that. So the three sources of where you can buy, reinsurance. So there's going to be what we consider professional reinsurers. there's the reinsurance departments of primary insurers, and then reinsurance pools, syndicates, and associations. And so we'll talk a little bit about each one of these. But you want to know at least probably, probably the professional reinsurers and how they kind of interact and how they work a little differently. And the syndicates is also a term that may be new to most people. So when we talk about professional reinsurers, typically they are going to be, they talk about what's called, there's a couple types. There's a direct writing insurer, and there's the reinsurance intermediary. Most likely, you're probably going to be dealing with the reinsurance intermediary. So if you're working like with Marsh, Aon, Willis, they're basically a broker. They're reinsurance intermediary. They're working, they'll work with the primary insurer and several reinsurers. Their idea is that, if we already have the one, they're going to help broker the best deal. They know the client, and their job is to shop the policies, essentially. And the job is to convince the reinsurer that the primary is a good risk. So they're representing the primary in this case. And then trust and full disclosure is essential to the reinsurance market. And on that. So what I want to make, because there's two questions that came up earlier today. One was, how do you know that the reinsurers actually have money to pay for claims? Who's watching them to make sure that they're solvent? Because the primary has regulations. Well, who's regulating them? Well, most of the reinsurers actually, the majority, I think, if not all, they're based out of Europe. And everyone's pretty much heard of Lloyd's of London. And most people think Lloyd's of London is an insurance company, but they're really not. Lloyd's is actually just it's a house. It's kind of like the New York Stock Exchange, in which people buy seats to be able to sell insurance, essentially on the floor of the Lloyd's house. And so people buy space. And so you'll have Munich Re and all these other reinsurers there. And part of what they're doing that's a little different is that all the policies, they have these tables and they have the underwriters. Literally, the idea is that you're looking these people straight in the eye and convincing them that you're a good risk. And compared to where most people buy insurance online now or over the telephone, everything is done in person. And if you think about it, the mortgage crisis and things like that, where people were selling over the phone and didn't know what they're buying, it's one thing to maybe do something over the phone. It's another thing where you're representing a client and you're always there every year, and you're going to have to look them in the eye the following year when you basically screwed up. And so there's a lot of trust. So it's about relationships. The reinsurance market is very much about relationships. And to the question of solvency, in Europe, they've actually passed what's called Solvency II. And Solvency II is kind of like our, it's Sarbanes-Oxley, but it's also the new credit reporting kind of regulations, Frank-Dodd Act, that's what it was. And what it requires is that the reinsurers actually have to retain, just like where we said 10%, they have to have 95% capacity or surplus. And so they have even much higher requirements. And and so that's regulated. Solvency II is through the European Union. And so anyone that writes policies essentially in Europe, so Munich Re, Swiss Re, all those type of companies that are reinsurers have to comply with Solvency II. And actually I went on Munich Re's website and they talked about, Solvency II is that they're helping companies adhere to that requirement. So hopefully that answered the questions regarding that. So we do have one other question, it looks like. So the question is, so if reinsurers are mostly in Europe, do rating agencies like AM Best or other also evaluate the reinsurance behind the carrier when they give their ratings? My understanding, so that is the other part. So there's the Solvency II aspect, but then there's like Standard & Poor's, there's AM Best, and so they're also going to have, just like regular insurance companies, they're going to be AAA rated, AA, single, those type of things. So there is the rating aspect that goes with it. So they put them through stress tests, but from a testing standpoint, you're not going to, the good news is you don't have to worry about this part, but it's good information to know. But there is basically regulatory backing that looks into those, and Solvency II is a huge change for the insurance industry. And there's also Basel II, which is also the regulations on the banking industry in Europe. So between the banking and the insurance industry, those are the two areas. Because the reality is insurance is all about investment. It's investment banking now. It's the same idea. People are putting their money in. So hopefully that was able to answer the question there. So close that back up. So the other types, I kind of skipped over direct writing insurers. It's employees that deal directly with the primary insurers. It might be another one. Again, you're probably not going to see that. You're going to see the broker as being the primary. You also have reinsurance departments of primary insurers. So what is that? So just like Munich Re, Swiss Re, they all, most of them also have, they have primary insurance arms, so they're arm's length away. So the idea is that they can write a policy, so they might have affiliates that they can write with. Just like I think AIG owns Chartis, and they own a couple others. So most of the large insurance companies in the U.S., when you look at them, you know, they have the one name, but they're actually owned by one major insurer, and so they're all considered affiliates of the main, and so they actually help write coverage, and then also in many cases can also write the reinsurance or help provide some of that reinsurance. The other piece of this is the reinsurance pools or syndicates and associations. So reinsurance pools, you probably see those more in terms of, well, I guess associations, so like pest control. And what you're going to see when we talk about associations for reinsurance, they're actually captives. So it's kind of a misnomer that they use the word associations, because in order to write coverage or be a primary, they actually have to be a captive. Or a risk retention group or some other type of, you know, legally insured type thing where they can write coverage. And so I know there's a pest control one. There's actually one for the energy industry where they have insurance. So like, let's say Clark Pest Control, which is in California, they may belong to a pest control captive. So they're buying their primary coverage from the captive, and the captive is then going out to buy reinsurance for the group and purchasing that. The other reinsurance that I think I show on the next one here is this is one that actually I used to go to their meetings, which is Government Entities Mutual Insurance, or GEM. And so you'll see on here on the corner it says Government Entities Mutual is a member-owned and controlled insurance captive. GEM provides reinsurance coverage to its members for liability, property, and workers' compensation. And so GEM was created, I think, over about 10 or 15 years ago. And so a lot of self-insured pools in California, as well as actually throughout the U.S., belong to this basically reinsurance pool. And then, of course, they're providing reinsurance, but then they go out to the reinsurance market and also buy additional reinsurance on top of that. But I know at least two pools, Washington State Transit Insurance Pool and then California State Transit Insurance Pool. So they're local transit agencies. So Omnitrans in Southern California, Alameda Transit and others, they may belong to this pool in which they buy insurance, and then others, then the captive then buys it for them further on. So when we talk about professional, you know, a little more in depth as we go in here. So the professional reinsurers, who are those? It's an insurer whose primary business is serving other insurers' reinsurance needs. And so when we look at, we're going to have the direct writing insurer, which we mentioned, and then the other one is the reinsurance intermediaries, which are the brokers, which is the most common. So primary insurers dealing with direct writing insurers often use fewer reinsurers in the reinsurance program. So here's some of the facts that go with it. So, for example, we use Alliance and several others. Basically, when someone is a primary business, is a broker, is to get other insurance, they develop relationships. So just you know, with those reinsurance pools, so they're going to have maybe 3 or 4 that they have a really good relationship with, and occasionally they might go out to others if the need arises. But the idea is that you're, just as you kind of have your favorite restaurants or you have your favorite type of things, you want to have that relationship. If you're changing, when you go from a broker standpoint, if every year you're changing insurance companies and doing something different, you have no relationship, you're not going to get a good deal, basically. You know, you're more likely to have a better deal when you work with someone on a regular basis. So again, when we talk about reinsurance, it's very much about relationships. The reinsurance intermediaries often use more than one reinsurer to develop a reinsurance program for a primary insurer, And so that's the other thing, is when they work with one, they're also working with the others, and they know, because they work together, they basically develop the layers. So they work to develop a whole portfolio, a whole program for the reinsurance. Because typically, you're not just going to one reinsurer for your program, you're going to have multiple depending on the layers, as we'll see here in a little bit. Reinsurance intermediaries can often help secure higher coverage limits in catastrophe coverage. And again, that goes with the relationships. They can help sell the program. They usually have access to various reinsurance solutions from both domestic and international markets, which is true, so they can find what's best in the U.S. as well as they'll have relationships in London. And also can obtain reinsurance under favorable terms at a competitive price, because they can determine prevailing market conditions and work repeatedly in the market with many primary insurers. So the other thing is that if I'm a broker and I'm representing University of California, but I also represent maybe Yale, Harvard, or some other universities, that reinsurer may give also preferred rates because they're bringing a whole book of business with them. And brokers typically, they have specialties. So one might be specialties transit, one is universities, another is petroleum industry or whatever. So they have a book of business that they essentially bring to those reinsurers, and that's part of the reason why they're the most common, because they know the industry, they know the risks, which ones are better when they do that. So now we're going to actually go into the different types of reinsurance. So when we talk about transactions, really just there's two basic types that you want to make sure. Treaty reinsurance, which will be really the most common, as we talked about, in the facultative reinsurance. So treaty reinsurance covers an entire class or portfolio of loss exposures and provides that the primary insurer's individual loss exposures that fall within the treaty are automatically reinsured. So the idea is, if you have a contract or your portfolio, that it's your homeowner's policies, automatically, because it's written under these forms, it's going to be covered. There's not really no questions asked. And it's the foundation of most programs. Part of the reason why it's popular is it avoids adverse selection. What this means is, when we think about it, is that if you said, if I'm in the primary coverage and I say, okay, yeah, we want to have this policy, but tell you what, I only want you to cover flood and earthquake and mold, and we'll take care of everything else. Well, I just gave them all the bad risks. So from them, it's not worth. It's just like with the healthcare. You want to take also the people that aren't going to have to use the policies to write that premium as well. And so that's the whole idea of treaty reinsurance. Is it's a whole portfolio, so taking the good with the bad. So I'm not just hand-picking those risks. So that way the policy is a little fairer on that. Also, typically, it's a long-term relationship. While it might only be for 1 year, the idea is that with a reinsurer, typically you're going to be sticking with them 5, 6, 10 years down the road, most likely. Even though you can change each time, if you do that, no one's going to write your policies, because they know you're just going to change the year after, and you're probably going to see higher coverage because you're just continually shopping the market. In the insurance industry, shopping the market, it's okay to do it probably once every 5 years to kind of do it, but to shop every single year, it doesn't work. Both even on self-insured pools with joint powers, they really don't like cities or any public entity to even do that. So the facultative reinsurance, how is this different? It's insurance for individual loss exposure. So that's where we say, okay, we're only going to write for earthquake, or we're only going to write for hurricane. That's where the facultative insurance might come into play. It submits exposure to the reinsurer. So if I say, hey, I want to write coverage for this type of line of business, and or this type of exposure, the reinsurer can say yes or no. With treaty, that's much more difficult, because it's the whole package. They really can't say yes or no. They can, but they're more likely they're going to say what the rate is. But they may say, we really don't want to take on that specific risk, and they'll say no, and they'll have to shop it around. And part of that, it's priced to reflect the likelihood of adverse selection, the idea that hurricanes are a bad risk. Now, granted, we just heard in the news that this was the lowest hurricane season, least eventful in how many years, and so the insurance companies made out pretty good, or especially the reinsurance market made out very well because they didn't have to pay out any claims. And then, the reinsurance for facultative has 4 primary functions. Because you go, well, why would you want to do it if it's not a good deal? Provides large line capacity for loss exposures that exceed the limits of the treaty reinsurance agreement. So the idea is for, okay, a good example, earthquake. You know, you can get certain coverages within California that'll cover most of that stuff, but there's nothing that's going to cover really a major earthquake, so you may have to have a special facultative coverage for earthquake. The reality is that the coverage is way too expensive because of the exposure is such a huge risk. So no one's even going to write it, even if you want them to at this point. You can also reduce the primary insurer's exposure in a given geographic area, which we kind of talked about. You know, if they only want to have risk in this specific area, they can do it. They can ensure loss exposure with the typical hazard characteristics and maintain favorable loss experience of primary insurers' treaty reinsurance and associated profit sharing. So what that basically is saying is that I can carve out this one area because I know if I include it in my regular, because it's a common occurrence now, if we're seeing that wildfires are more common in this area, maybe I want to carve that out of my treaty and make it facultative. I'm going to pay a little more because it'll help my treaty reinsurance policy. Because what may be happening is my treaty reinsurance policy is getting affected so much by these more common occurrences that I need to really take a look at it, and it's not spreading my risk as much as maybe I wanted to. And then can insure a particular class of loss exposures that are excluded under a treaty reinsurance, which is basically kind of what we just said there. Okay, so as we always mentioned in the past, if you can describe what's on the chart, this is really the key here. So if you look at reinsurance, this is a really good way to kind of look at how does this work. We have our treaty reinsurance on the one side and the facultative on the other. And then under facultative, we have pro rata and excess loss. Same thing, pro rata and excess loss are the types. And then under pro rata, we would have quota share and surplus. And we're going to go, cover those two in a moment. And then also under excess of loss, you're going to have per risk, per policy, per occurrence, which would be catastrophe, and then aggregate excess. So as we go through the next couple slides here, is be able to understand how do all these pieces fit together and how do they operate, and kind of see where the decision tree kind of looks. That you can have pro rata under both, but how is treaty and facultative different on those? So when we talk about pro rata insurance, its primary and reinsurer proportionally share the amounts of insurance, policy premiums, and losses. So the main thing on this is if you get a question, pro rata is exactly what it sounds like. It's proportional, right? So the idea is either going to be based upon a certain amount or a percentage, but it's going to be proportional, that the primary is going to take on a certain amount and the reinsurer is going to take on a certain amount. And that what it also means is that the primary is also going to share the policy premiums with the reinsurer. So basically, we're all going in this together under this type of environment. So it's kind of cumulative. So under quota share reinsurance, it's a type of pro rata insurance, reinsurance, in which primary and reinsurers share the amounts of insurance policy premium using a fixed percentage. Okay, so quota share is the fixed percentage one, whereas surplus share is pro rata, in which policies covered are those whose amount of insurance exceeds a stipulated dollar amount or line. Okay, so the difference, I think I didn't put the slides in here, but they're in the book. But the idea is that we put quota share might say, okay, 25%, I collect 25%, you get 75% by taking on this risk, and we share both premium, everything, the losses all down the line. Surplus share is that we're going to say it's like cats. We're going to say once it exceeds $100,000, I'll take the first $100,000 and you're going to take the rest. And then at that point, we'll start doing pro rata share after we hit that surplus amount. And they show this in the book and the charts fairly well. From a test standpoint, the main thing I would concentrate on is just to know that pro rata share is exactly what it sounds like. Okay, it's proportional. It's shared risk among both the primary and the reinsurer, and I think that'll get you where you need to be is from a testing standpoint. Okay. Okay, so the question it looks like came in just a comment based on the last discussion. I have a carrier who thinks it knows how to model better for earthquake damage and is introducing a new product for homes in California next year. And asked them about getting reinsurance, and they said no problem. Their reinsurers have a lot of confidence in what they're doing and going to provide this coverage for catastrophe exposure. and there's more information on that. So actually, to that question, the whole modeling aspect, a couple years ago, I had the opportunity to go to the Haas School of Business, and we met with and they had a risk management class. And basically what was amazing is all the students in there, they're basically doing models of exactly what you're talking about, of trying to develop derivative models, all these different types of things to basically do that. And it'll be interesting, you know, if someone still starts writing earthquake coverage, I guess I'll see it when I believe it, but I'm just skeptical when it comes to earthquake. No one's been able to do it yet, at least in California. So the other reinsurance types was excess of loss. So we talked about pro rata, now excess of loss. And this is really the more common one that you'll probably see, where in this case the primary insurer is indemnified for losses that exceed a specified dollar amount. And this is what we talk about layering, and we'll show some examples of what that layering looks like. So, and there's the different types. There's a per risk excess of loss, catastrophe, per policy excess, per occurrence excess of loss, and then finally aggregate. And again, we'll talk about each one of these more in depth. Under this type of policy, the reinsurer only pays when loss amount exceeds the attachment point. Okay, and we'll show the attachment point. And reinsurers do not pay a ceding commission. So that's one thing I forgot to mention in the other, in this one, is that under pro rata insurance, there's a ceding commission, which basically means that the reinsurer is the reinsurance agency, because they're going to be writing these policies, are basically going to help pay the commission to the person selling the policies. So that way it doesn't take the profit out of the primary. So that's what a ceding commission is in that case, is that by doing this type of arrangement, they'll do that. Under a excess loss of insurance, they do not pay a ceding commission. It's flat. It's all included because they're not selling. It's all included in the policy that there has to be no encouragement really to sell it, I guess, is one way to view that. So how does this work? So this is, you know, if you think about how things would be layered, you know, they give this example when they talk about retention. This is where people, I think, get confused. This is the retention of the insurance company's $250,000. Okay, I think they should have made these higher, so you know, because otherwise it looks like a you know, an employer. So the insurance company is going to be writing at this level. So this is what their retention is. And then what they're going to do is they're going to buy reinsurance. This is their first layer. And so they're buying, there'll be reinsurance at the $250,000 layer. And then on top of that, there might be another reinsurer that does the $500,000, another one does, you know, for this layer, and another one does a $20 million. So the total coverage is $25 million. But what happens in here, the way this works is that I'll just use, let's say, this is kind of where the retrocession might come into play, is that maybe one insurance company says they're going to basically do the reinsurance from $250 all the way to $25 million, okay? So they may buy that whole thing. But then what they're going to do is they might say, go to another reinsurer and say, hey, I want you to take this second layer, and you take on this layer, and you do this one, and I'll take on this $5 million. So the capacity right here, this one is $5 million, and this goes up to 25. So I'm buying a $20 million layer. So this is what 20 excess of 5 is basically what I'm buying, which basically means if there's a claim that finally gets up to $5 million, this third reinsurance party is going to finally pay out. Now, when you get these higher layers, the cost of that policy is really pennies to the premium that's being collected. So down here, you might, because there's more likely going to be an attachment, it might be, you know, maybe it's $1, you know, or 50 cents per premium, and you keep going up, and this is, you know, 10 cents. And by the time we get up here, you're only paying 1 cent per premium dollar collected. Okay, I'm making these numbers up when we talk about the amount there, but that kind of hopefully will give you an idea of the way that would work. Okay, so the most expensive. So the question is, what layer is the most expensive? It's going to be this bottom layer, and the reason why the bottom layer is going to be the most expensive is because you're expecting activity. If you think about losses that an organization has, and let's say this is for workers' comp and an aggregate coverage, you may, and each policy, let's say it's a per occurrence, so it's up to 250. That I'm going to cover up to 250,000, and then most likely most of my claims are around 50,000. So the coverage will I'm probably good there. But occasionally I get claims that do pierce the 250 layer. and maybe I get 50 of those a year. Well, and by the time, and maybe in this $500,000 layer, I might get, so the total claim's up to $1 million now, by the way, right here. But this person's only be responsible. By the time it gets to $500 to $1 million, I may only get 5 claims, and then go from $1 million to $5 million. Maybe it's 1, and this is like almost never happens. So the idea is that as you go, this is going to be fairly cheap, and as you keep going down, this is where it gets more expensive because you expect activity, and that activity is going to be seen in your actuarial analysis. They'll be able to tell you, what an actuary will be able to recommend what layers you need. Now, let's say that we only bought up to, as a primary, we bought reinsurance that went up to $1 million. That means any claims that went above $1 million, we're back on the hook for it, and that would come out of our surplus, okay, or net worth. So that's basically how reinsurance essentially works, and we'll give, I think the article, helps provide some examples of that as well. But the whole idea is layering, and what people don't see is you might say, well, we have $20 million worth of coverage. So I think for UC, we have $5 million worth of, for self-insured retained. In this case, if you kind of say excess, then I think we're up to $25 million as our total, workers' comp if we ever had a claim. The reason why would you need that is because if you have a single event or one occurrence where multiple people are getting injured, it may impact, and that's where you might actually have where you actually use that insurance. So again, this is really for catastrophes. So we talk about excess of loss reinsurance. We have a couple things that we want to talk about. The subject premium. So this is the premium the primary insurer charges on its underlying policies in which a rate is applied to determine reinsurance. So when I was talking about pennies on the dollar, or 20 cents or something like that, what the premium they're going to charge is they're going to say, okay, if we're charging a policy premium that's $500,000, they may say we're going to charge $1 for every 1,000 in premium or something like that. But there's going to be some formula that they've come up with to say what their charge is going to be based upon their past experience of what makes sense of what they need to collect for it. Then there's also what they call the working cover, and this is excess of loss reinsurance with a low attachment point. So if you look on here, this low attachment point, this is the working cover for this policy. Okay, enables a primary insurer to spread losses over several years by anticipating profitable years will offset unprofitable years, and it's good to enter a new market. So, and I put on here, it's the same concept of organization starting with a small SIR. So if I'm just starting an insurance company, I'm probably going to want to have a low attachment point that reinsurance will start kicking in. And eventually, I'll probably get up to where I start writing, I'll retain up to $5 million eventually. But I need to get that capacity and have enough premium to be able to do that. And then also there could be what's called a co-participation provision, which is a provision in reinsurance agreement that requires primary insurer to retain a specified percentage of loss that exceeds its attachment point. And I think I'll show this on one of the slides here, what that means. But I know it talks about, but the idea is that maybe it's 5%, so that there's kind of some skin in the game beyond just paying for it. That the co-participation is also the idea to help them make sure that they manage the claims so they don't pierce the layers. So there's just not this moral hazard kind of aspect to it. No, it's not, it's not our problem anymore, and they just leave it. So that's part of the co-participation, is that they know that they can control some of the costs that are with it. So when we look at the types of excess of loss, there's going to be the 5 types. You do want to know these. This is more likely to be on the exam than the pro rata. And so we're going to go through each one of these, but certainly you want to make sure you do know the 5 types of excess loss reinsurance, because there definitely will be questions. So the first one is a per risk excess of loss, which covers, in this case, property insurance and applies separately to each loss occurring to each risk. So, so the loss exposure is determined by the primary. So in this case, you might say, okay, the risk in this case is each building. So we have 3 different buildings, and they may have had losses at different times. Under this policy, it says it's a per risk excess of loss reinsurance applying $950,000 excess of $50,000, which basically means the primary insurer is going to cover the first $50,000, and then then the reinsurer will come up to $500,000. Now, the one thing that's probably not in here, let's say it is a property loss coverage, is usually the person being insured probably has a $1,000 deductible as well. So they're not. So just keep in mind, people kind of miss that, but there's probably that piece of it. So if there's a loss, let's say we just had some friends that had unfortunately a chimney fire, and so they have a claim now, and so now they're if they lost their home, the primary insurer would pay up to $50,000 under that policy. Let's say the policy was $500,000 or $600,000. What's going to happen is that the primary insurer is going to pay the $50,000, and then the loss, whatever the other loss amount, in this case, the reinsurer is going to pay the rest of the balance of that. So the total exposure in this case for the primary insurer is only $150,000, but the reinsurer in this case paid $1.4 million. And you might go, well, why? That doesn't seem like it's a good deal. Well, you have to remember that all these other things that didn't have any losses, that most likely the reinsurer probably collected $4 or $5 million, and so they're only paying the 1.4 out. So it's still a pretty good deal. So when we look at this, we're not talking about the money that's being collected. It's only looking at how the attachment points work. And I think that's where sometimes people get confused saying, well, it's not a good deal. Well, no, you're not seeing the income come in. This is only talking about the payout. Okay, so that's basically how it works. Just think of it as deductibles like you would normally have. This is a deductible for the insurance company. The other one is catastrophe excess of loss reinsurance, which protects the primary insurer from an accumulation of retained losses that arise from a single catastrophe event. Now, there's specific clauses that you'll see under these type of things. And so I put in here a clause that you might see in a policy like this. And so, for example, for there might be a specification of a period of hours that is specified of what considers to be occurrence. So I think we've talked about a couple classes ago, well, if you have an earthquake, well, and you have the aftershocks, is each one of those a separate occurrence, or is that one? Well, they actually will define that in the insurance policy. And so usually a period of hours is specified. So hurricanes, 72 hours for hurricanes, and 168 hours for earthquakes, in which claims can be aggregated and applied to the attachment point. So they'll put a clock on it, or how many days, and they'll say, okay, this is how many days. Then we know that we're going to cover all these things as one occurrence. And again, that how that piece might work there. Another question: how does the 950,000 excess 50 relate to the 1.4 million? So I'm going to go back one slide here. Okay. So the 950,000. So the question, and I think now this is the other part I can see where it can be confusing, is that under the policy, the reinsurance policy, is that what this is saying is that as the primary insurer, I'm going to insure up to the $1 million. Okay, so if I'm primary, I have $1 million worth of coverage for this homeowner, let's say. So this is 50 plus the 950 is 1 million. So all this is saying is that if I have a loss, that as the reinsurer, as long as it doesn't go more than 950,000, I'm paying everything. If there's a claim on here, let's say that was $1.2 million was the loss amount, there would actually be another column over here, and what that column would show is 50,000. Then the reinsurance payment of what they would pay up to the max would be 950,000, and then basically the other column would be right back to the primary. This would be uncovered or unfunded loss, which means the primary insurer would have to pick that up. So the 1.4 million in this case, compared to the 950,000, this is just aggregated for each one. The 950 comes in for each occurrence. This is the max I can pay for each individual occurrence. But this can accumulate, and if the reinsurer doesn't do if they could have 100 claims, and this thing could blow up in their face essentially, and they'll lose money under the reinsurance arrangement. So the idea is based upon losses, this is what they'd expect, and that they would charge the appropriate premium for this. Hopefully, I don't know if hopefully I try to explain that well enough. Jim, do you have did that work for you? Kind of. So if I need to, I'll see if I can explain a little bit more. Okay, great.
Per risk and the total summing from the individual risk.
Yeah, and I think that's so the different. And I think one thing you'll see in here is that's a good point, Jim. Is that on the per risk, each one of these is individual, and so the reinsurer is on the hook individually for each individual one. Now, when we talk about an aggregate a little bit later, that means there's going to be a total amount that gets done, and you'll see how that works in a moment. All right, so we talked also about catastrophe. And then also primary can specify the data and the time when the period of consecutive hours begins, or the date and time. So so it depends on, again, when do they want to say the clock starts ticking, all those type of things. There might be some, and I would also say that this is probably where legal things get involved as well, of what's going to be covered, what's not going to be covered. So this is how it would work in this case. So the example of the operation of a loss occurrence clause in a catastrophe excess is that we have on day one, so let's say it's an earthquake, for example, and in this case it says, I think in here, so the total losses that could potentially apply to reinsurance agreement are $7 million if the 72-hour period starts on the second day. So the idea is that we're going to have, in this policy it says 72 hours is what this is specifying. So the first day we have $1 million worth of loss, day 2 $1 million, day 3 $2 million, day 4 is $4 million. So the total losses of this one event is $8 million. Under this policy, that depending on, if we said the policy started day 1 and went through day 3, it would only cover $4 million. If we say the event started when I want to get the clock ticking, starts on day 2, then now I have $7 million worth of coverage. So picking up, having the date of when the event actually occurred, if it allows for that in the policy, can make a difference. Now, another question you can say, well, when do you pick the date of when you want? Do you do it afterwards or do you do it before? To be honest, I'm not sure. I think that's all going to be, that would be specified in the contract in there of who specifies at what time. Was it the first when they get a call of notification of loss? I mean, there's all these things that would come into play, but this is mainly to show you how a catastrophe policy might work and what's covered.
What happens to the, if you assume you start the clock on day 2, what happens to the expenses from day 1? Do you just figure we'll absorb that and it's cheaper than?
Yep. And so the $1 million would be retained by the primary, which in that case would probably be a pretty good deal. To take the $1 million, you get the extra 4. I mean, that's kind of what would happen. I mean, if you had the choice in this, but it kind of shows, depending on when an event occurs from a catastrophe, it can make a huge difference. And well, and this kind of comes into play of, okay, Hurricane Katrina. Okay, you had the hurricane. Well, it wasn't the hurricane that would cause a loss. It was the flooding after the wind, or the wind event, and that was also a whole thing. Well, was it the wind event, or was it the flooding? What thing actually caused the damage? And then people had to fight their insurance companies over that. So on this, basically, kind of shows, and what I wanted to show on here is how, from a catastrophe, how this might work. And so, so in this case, they show amount of this is from how they would charge, the reinsurer would charge. So if the amount of loss subject to the reinsurance limit is $10 million, and in this case, they're going to retain $750,000. Okay, so this is the total amount, which means the amount of loss that the reinsurer has is about $9.25 million is what their exposure is, because they're going to retain the $750,000, right? So now the next thing is they have a co-participation amount, and what this is that it's the reinsurer's requirement is that they have to pay 5% of what the reinsurance amount is. So 5% times 9.25 is $462,000. So then what you do, this kind of step by step on here, is you take the 9.25, subtract the 462 co-participation amount, and so now the total amount that reinsure, the max amount that they're going to be exposed to under this policy is 8.7, essentially 8.8 million, basically. So if you break it down, what the retained risk for the primary insurer is the 750 plus this 462, and so this is what they're on the hook for. If they don't have any losses, okay, so if they don't have any losses, or if maybe the losses don't exceed that point, I mean, they're not going to, it could be less than this, okay? It depends on what has to be paid out, is that co-participation amount. That will go down, basically, depending on if there's an event or not. Okay. Now, the next policy is a per policy excess of loss reinsurance. Okay, and this applies the attachment point and reinsurance limit separately to each insurance policy issued by the primary, regardless of the number of losses occurring under each policy. Okay, so this is more from a policy standpoint, whereas the other one, might say, okay, it's per occurrence. We're saying, okay, this is a per occurrence, a hurricane. We're going to cover all the policies in aggregate. This is now saying each individual policy we're going to insure to a specified limit. In this case, the example they give is this is 900,000 excess of 1, which means that under this policy, the loss amount was 300,000 as the insurer. I only have to, the primary, I'm paying 100,000 on each one, and you can see the reinsurer's payment is just the difference of what that is. So the key concept here is that all these things are pretty similar. It just depends on, is it per occurrence, is it per policy, is it an aggregate? That's really, you just have to be able to understand. This is the per occurrence excess of loss reinsurance. Okay, so this applies to the attachment point and reinsurance limit to the total losses arising from a single event affecting one or more of the primary's insurer's policies. Okay, so you could have this is similar to a catastrophe event to a certain extent. Or actually, let's take a good example. Let's say there's a car crash. Okay, you have a multi-car pileup. Well, a lot of times, you have three. What if you all have Geico or Allstate or whatever? You all have the same company. Well, what happens? Well, this would be a single event. In this case, it's not a catastrophe. It could be a regular event. And then under this type of policy, is the loss amount would basically be aggregated, saying under this policy, if we had a situation like this, the max as a primary I would have to pay would be the 100,000. It's aggregating all the policy amounts, so the total loss would be 1.4 million. I'm on as a primary 100,000. The reinsurer is going to take the risk, and part of it is how likely is that type of event to occur, those type of things. But you can kind of think, or if it's it could be a smaller, instead of a hurricane where it's affecting, actually in many ways this is very much like catastrophe insurance, I guess, when you look at it, but also because of the high limits on it. But most likely you're not going to have 100,000 attachment point on a policy, on a catastrophe policy. It's going to be something much smaller. And then clash cover. So this is something new that wasn't in the textbook last time. And this is a type of per occurrence excess of loss reinsurance that talks about for liability loss exposure that protects the primary insurer against aggregations of losses from one occurrence that affects several insureds or several types of insurance. Okay, so it's similar to kind of what we talked about. So it has an attachment point higher than any of the limits of the applicable underlying policies. An example of occurrence that injures both employees and visitors would have both workers' comp and GL claims. Clash cover would provide as one occurrence for the reinsurance purposes. So the example I would give is that you have a fire in a building. Okay, you have employees in the building, which we cover workers' comp, and you have visitors covered under general liability. In the event, for whatever reason, they would sue, those type of things, people injuries. So your work comp policy would have a certain coverage requirement of what you're paying. Your general liability will have a certain coverage. And once you exceed the aggregate amount, this policy would then kick in, depending on what that clash coverage is. So the idea is these policies are clashing. You have multiple policies. It's almost like an umbrella. Kind of think of it that way. All of a sudden, all these things you're aggregating because typically you're looking at one line of coverage versus another, and this is now combining the two, but it has a higher attachment point when you look at it. And I think this is so here's an example of what this might look like. So in this case, we have so one occurrence involving multiple claims. So we have 6 different policies here. So the first one, the retention for this policy. So these are different policies of different types. So that's the first thing you have to keep in mind. So they're saying these are 6 different policy types. So the first one has a retention for the primary of $250,000 and a per occurrence of the reinsurer of $750,000. So the damages were $1 million. There's nothing that kicks in at this point. On this one, per occurrence, there's nothing for reinsurer kicks in there. Okay, same. Now this one's a different policy. It has a retention of $750,000, and the per occurrence reinsurer is $250,000 on this. And by this point, we've exhausted the limits. And what they don't show in here, unfortunately, and they don't talk about in the book, is what the total policy limits are. They just kind of show examples. So this is where it kind of gets a little confusing maybe. But you can see here that under this type of situation, I'm limited. My policy under this, I took the full max on this as $750,000, and the full max of this policy limit on $250,000 as the primary insurer. My per occurrence reinsurer, they took the maximum hit on this of $3 million on these types of policies. And by this point, the limit was exhausted. So now the clash cover, the reinsurer comes in and covers the other $2 million.
Okay. The numbers for that table are on the previous page in the textbook,
okay.
Which is why you can't find it.
Okay, that's probably fine. So, which, you know, it's nice when they put them all together. So, so look, if you look at this chart and go back and look on the previous page, and you'll be able to see that aspect of it. Now, having gone over this, I wouldn't expect really too much of a question on this type of thing. It's just to understand what is a clash cover, that if there's multiple policies, then this would come into effect. I would say it's more important to understand the definitions, understanding how the layers work in general, and what the attachment points are. It's good for everything, but then just understanding what a per occurrence is, what an aggregate is, that's really where it's going to come in there. Now, also, the other terms that they list in there, there's two others that they list before we go into aggregate, is extra contractual damages. And these are damages awarded to the insured as a result of the insurer's improper handling of a claim. So the idea being that if I'm the primary and I have my own adjusters and they didn't handle it properly, they screwed up, they did a couple different things, it could be that the reinsurer can go after damages. You know, from an indemnification standpoint, they're still going to pay the claim, but then they're going to go after, probably after the fact, and say, you know, you owe us money because this wasn't handled properly. From a contractual, you know, you can go for contractual damages, so they can certainly do that. The whole point of this is, does the person that's insured get harmed in this? It's really, I mean, this is kind of a separate issue, that the payment was going to be made. They're obligated to do that, but they can certainly go after them for not handling this properly. And then excess of policy limits loss. It's a loss that results when an insured sues an insurer for failing to settle a claim within the insured's policy limits when the insured had an opportunity to do so. You know, well, people think, well, how would you know if you have an opportunity? An opportunity exists when a settlement offer came and you decided to take it to court still, and then you ended up getting a lot more, or you know, you could have settled at $250,000 before it went to the policy limits or the attachment point, things like that. That's basically where you might have a policy limits loss, where they can go back afterwards and say, you didn't handle this appropriately. Now, when you think about that, that's also probably the reason why you see a lot more things settled. You know, people go, why don't you defend it? Why aren't you pushing this? So most primaries probably don't do it as much possibly because of that concern. And I would say individually, if you're an employer that you're self-insured, you're more likely to take those risks because, you know, you don't have necessarily those obligations up there. Okay. And now the final one is aggregate excess of loss reinsurance, which is covers aggregated losses that exceed the attachment point that occur over a stated period, usually 1 year. So we say once you hit this point over a period of 1 year, then everything else is covered. Reinsurance is less common and it's much more expensive because it's a stop loss. The idea is that if you say you're going to cover everything after it gets $20 million is then where the attachment point, they're going to take everything else on. And your loss history shows that you've always paid up to $15 million. There's a pretty good, it wouldn't take that much more to get that attachment. There are some policies in California, for example, that for self-insured groups that require that they actually have to buy aggregate coverage for attaching at $500,000. And the reason why, because it helps stability for these new self-insured groups, they put that provision in there. Well, that also made the insurance a lot more expensive when they did that. Now it's not quite reinsurance, but it's the same concept. When you have that attachment point, it's going to make it a lot much more. And the attachment point can be a dollar amount or a loss ratio. So when it stays a loss ratio, it's called a stop loss reinsurance. So you can say the primary retains up to 90% of the loss ratio and then stops the bleeding. So the idea is that if it's a percentage of their total losses, they say 90%, and that way they know they're still going to survive. The idea is, when it's percentages, that they know the company's not completely out of business by doing that they're still going to have some capacity on the policy, and they can have more years to do that. or again, it can be a dollar amount in some cases that you might see that. So the last couple sections on here as we talk about our reinsurance concerns of risk management professionals. So typically most of the things when we talk about tonight, most of us are, if you're a risk manager, you're never really probably going to deal with the reinsurer. You're going to deal with the broker who's going to deal with the reinsurer. But as a risk manager, what are the things you need to be concerned about and when you might deal directly with the reinsurer. And here's a couple of the situations. And this might most likely, I would say, probably be a test question as well, just because it's one of those things that, since reinsurance is kind of one of those anomalies of when do you actually have to get involved. And so the first one, a reinsurer takes the place of insurer as a result of a portfolio insurance arrangement. So basically, because the primary, folds or they sell it and the reinsurer comes on board, that might be a situation. The reinsurer takes a place of insurer through a cut-through endorsement added to an insurance policy. So basically, they kind of describe a cut-through endorsement a little bit, but the idea is that the primary is not going to be, there's a certain exclusion, let's say, in the policy that the reinsurer is willing to take on as a direct insurer, essentially, and that would be a cut-through endorsement, that they're basically going to take on the individual risk that's being excluded from the primary insurance. An organization establishes a subsidiary that insures or reinsures the organization's loss exposure. So when we talk about an organization establishes a subsidiary, they should just have captive or risk retention group, because that's what they're talking about there, that insures or reinsures the organization's loss exposure. So just like with the University of California, with forming a captive, we are now, instead of dealing normally with the excess market, we are now going to start dealing directly with the reinsurance market. As a captive, we have that ability to do that, where we didn't before. And the advantage when we talk about captives in the next couple chapters, chapter 10, is that that premium surplus, or the premium charges, I should say, that get charged on there, that basically our costs will go down because we're not going to have the premium charges that would be charged to the primary insurer normally. An organization purchases reinsurance for a pool of which it is a member. So that might be where you get involved, because as a member of the pool of the board, you might be part of the visiting with the underwriting interviews. And then finally, a reinsurer or several reinsurers team up with an insurer or several insurers to provide coverage. And again, that's kind of a pooling arrangement, but you're working with several of the different pools to be able to do that. When we talk about portfolio, in this case, so the portfolio reinsurance arrangement, that would be the LPT. This is more of the details. The cut-through in case insolvency of a primary, we cut through to the reinsurer, and you'd want endorsement in case of low credit rating of the primary, or again, there might be exclusion there. Reinsurance through a subsidiary, talking about captive, and reinsuring a pool. So basically, just kind of more details on what I just provided there. So with that, we actually, I think, ended on time. If there's any questions, certainly we'll go ahead and answer those, or you can go ahead and email me separately and get those out. I do encourage everyone to go ahead and take a look at the articles that I sent. I'll also put those links on the website as well for others afterwards, so they get access to those. But I think they provide some good examples of kind of the reinsurance market and what's going on with those, and how they can certainly be affected by the different events, such as Hurricane Sandy, and how also one of the things, I guess the thing I'd leave you with is, even though all these other events, you might see insurance rates go up for property coverage. And so one of the things, the article that talks about with hurricane recently, because the hurricane season was low, is that rates are, the market's softening, you're going to see lower rates. That most people don't realize that the reinsurance market, what happens in things away from us, we always think of, okay, what did we do to cause our insurance rates to go up? The reinsurance market, what the primaries have to pay to get that reinsurance, can go up or down based upon events around the rest of the world. And so even though we go, we're doing great, we've never had a loss, why are rates going up? It's because of Superstorm Sandy. It's because of all these other things that cause the reinsurers to raise the rate, which then raises the rates on the primary, which then obviously affects those individually, which is another reason why if you go directly into a captive or risk retention group, you can control your rates much better and not having those fluctuations that are part of it. All right, well, thank you, everyone, and we'll see everyone next week. We'll be going over Chapter 7. Have a great night.